Good afternoon and thanks for joining me. My name's Tom Harvey and I'm a financial planner with J. Edward Sellers. Today I want to talk about some significant changes coming with pensions and how they're treated with regards to inheritance tax. More importantly, we'll talk about what we can do about it now while there's still time to act. Just a little bit of housekeeping before we get going. So this is actually a re-recording of a session that I ran earlier in the week. We ran into some audio difficulties first time round. Because of that, there won't be a Q&A session, but there's an email address on screen within the green area on the right, and please feel free to pop me any questions. The session should last around 30 minutes, and please note this isn't financial advice or shouldn't be taken as a personal recommendation. It is just for general information purposes. If you'd like advice on your own circumstances, again, please feel free to get in touch. So here's what we'll be covering today. So first we'll start with what's actually changing on the 6th of April 2027. Then I'll explain why the most effective planning takes years rather than months and how the 7-year rule with regards to gifting works. We'll then look at who needs to act first and what can safely wait, and the mistakes people tend to make by leaving things too late. Okay, so what is actually changing on the 6th of April 2027? So right now, most unused pension funds fall outside of your estate for inheritance tax. That has made pensions one of the most efficient ways to pass wealth on to the next generation. In fact, many people have deliberately spent other savings and investments, leaving pensions untouched precisely so it could be passed on tax-free. From April 2027, that advantage largely disappears, and any plans built around it may need to change. So here's the headline. From 6th of April 2027, most unused pension funds and death benefits will be counted as part of your estate for inheritance tax purposes. So it's now law. The Finance Act 2026 was passed on the 18th of March, receiving royal assent, and it applies to deaths on or after the 6th of April 2027. With many other changes that we've seen with pensions, there's been transitional protections. That's not the case here. So it will be effective for all pension funds built up to that date. Passing on your pension to a surviving spouse or a civil partner remains inheritance tax free, but that just means inheritance tax bites on the second death rather than the first. The government still expects, though, that 90% plus of estates won't pay any inheritance tax, although I think that is a questionable number. Okay, so I thought we could outline this with an example to begin with. So meet Mr. Smith. He dies at 78 with £500,000 left in his pension. His other assets have already used up his tax-free bands, so his nil rate and residence nil rate band. So the pension is fully exposed. First, there's 40% inheritance tax on the 500,000, which is £200,000. Then his children pay income tax at 40% on the remaining £300,000 as they draw it, if we assume they're higher rate taxpayers. That turns into another £120,000. Which is effectively a £320,000 loss to tax, or a 64% tax rate. There's a further trap that we need to be aware of as well. So some pensions only pay out a lump sum at death. They don't allow beneficiaries to draw down when it's tax efficient for them. So that could mean the full pension fund is paid out in one lump sum, tipping the beneficiaries into the 45% rate of tax depending on the value of that pension, which further increases that percentage charge or take from tax. Okay, beyond the tax itself, there is a practical reality and it falls on your family. So your executors must track down every pension, obtain valuations, and pay any inheritance tax due all within 6 months of death. If not, interest starts to build up. To find the money, they can ask pension schemes to hold back up to half of the pot until the tax is settled, and the remainder can usually be paid out fairly quickly. There's a new online HMRC tool on the way to help people work out what's owed, but the final guidance isn't expected until spring 2027, only weeks before the rules go live. The result is more administration, more delay, and more scrutiny for the people that you leave behind. Planning ahead spares them much of that. So that brings us to part two, and the reason I wanted to talk to you now rather than closer to the deadline. So the most effective planning takes years, not months. The options that help most are the ones that need a head start. Okay, so at the heart of this is the 7-year clock. People have probably heard about this before, and this is where the tax on a gift tapers away over the 7-year period following the gift. So table on screen there, you can see from years 0 to 3, it's the full rate of inheritance tax. Years 6 to 7, it drops down to 8%. So something that we need to be very careful of with this whole thing, the 7-year rule. The tapering applies to the tax payable on a gift and not the gift itself. So in reality, many people don't get to benefit from this relief. Okay, so this is the part which catches a lot of people out. So as I've said, taper relief reduces the tax payable on the gift. It does not reduce the value of the gift itself. And because gifts use up your nil rate band first, a gift within £325,000 has no taper relief at all. So let's take the two examples on screen. So a £100,000 gift, that sits entirely within the nil rate band, so 325,000. Taper relief changes nothing here. Obviously, a £325,000 gift for most people, that's not an amount they're looking to gift right now. So many people aren't going to benefit from it. If we look on a larger gift now, so a gift of 500,000, 325,000 covers the full nil rate band, and there's 175,000 which is popping its head above that nil rate band. So it's the taxable amount on that gift which then benefits from taper relief. As I said, the bottom line here, most gifts do not get any benefit of taper relief. So an immediate win is gifting from surplus income. So this is the one form of gifting which is free from IHT straight away with no 7-year rule. To qualify, the gifts must be made from income, not capital, and leave you with enough to maintain your current standard of living. So you can't go from eating out 7 nights a week to eating nothing but beans on toast. That won't pass the test. It is one of the most underused exemptions, and especially powerful if you've got pension income that you don't need to spend. So a client I met with earlier in the week is now in their 80s. They've been gifting away their state pension since they received it. So we're looking 15 plus years where they've probably given away in excess of 100,000. None of that is applicable for IHT. So a good one to get going with if you've got time on your side, because that's basically equal to an inheritance tax saving of over £40,000 just by doing that. With this, good record keeping is essential. So your executives must be able to demonstrate that the gifts qualify for this exemption. What a lot of people do, just before we move on to the next slide, is if they have a drawdown pension, take an amount in their basic rate, use that to sustain their lifestyle, take as much as they can up to the higher rate, and then gift that away. That basically means they pay 20% tax on it now, rather than 40% tax on it when they pass away. An extra thing that can be done to improve the situation, if the recipient of that income puts it into a pension, they qualify for tax relief at 20%, potentially if not 40% if they're a higher rate taxpayer, which again makes it a better situation because more money stays within the family. Another planning opportunity, and one that we've been doing more and more with clients since this announcement, is taking a 25% tax-free payment from the pension. 25% is generally the maximum. Some pensions have protected tax-free cash, so may be able to take more, but it is up to a maximum of the lump sum allowance, which is 268,275. If you've not taken yours and you don't need sort of immediate access to that lump sum, you can take it, gift it, either an outright gift or potentially a gift into trust. I do get quite a lot of questions about when trusts become efficient, and trusts are useful when you still want to retain an element of control, which we'll come on to in a couple of slides in a minute. So doing so starts the 7-year clock ticking as soon as you give the money away. And again, any future growth is outside of the estate. So one thing with inheritance tax, because assets in theory continue to grow, it gets a bigger and bigger problem. So giving it away or wrapping it in a trust helps out with that. Obviously, when it comes to giving money away, we have to think about what you're going to need realistically for the rest of your lifetime. So what we tend to do is use some tools that are available to us to sort of map out your income requirement over the rest of your life, using some sensible assumptions on rates of return, inflation of your expenses, and then we can work out how much surplus you may have, and that's the amount that we'd look to give away. The main thing is, though, it takes care, needs quite a bit of thinking about, because you don't want to leave yourself short in retirement. Okay, so coming on to trusts then, I'm going to run over 3 different types of trusts. And again, this is when you want to still have a hand on the wheel. The money, as the title says, allows you to retain some element of control over money rather than giving it outright. So 3 main trusts that are prevalent at the moment. So one is a loan trust. This is where you lend money to the trustees rather than gifting it. The loan itself stays within the estate, but all growth sits outside of the estate from day one. You can call on repayments whenever you need them. So this type of trust, it takes longer to be effective for inheritance tax, around 20 years normally, by taking 5% a year from an investment and spending that. But it gives you the most control. So that money that you originally put into the trust, you have access to that throughout. But takes a long time to become 100% effective at mitigating inheritance tax. At the complete other side of it, we've got a discounted gift trust. So this is the least flexible, but most effective for IHT. So this is where you gift capital, but keep the right to a fixed regular payment for life. So a slice of the gift, which we'll call the discount, is outside of your estate immediately, and then the rest follows 7 years afterwards. So rather than potentially 20 years plus for the loan trust to be outside of your estate, it takes around 7 years for the discounted gift trust to be outside of your estate, but you'll receive an immediate write down on that asset. So as an example, if you've got £100,000 at the moment, the write down might mean it's now £75,000 of value in your estate, so an immediate benefit. You also receive an income for the rest of your life, and then the full amount of the gift falls out of your estate in 7 years. Importantly, though, you don't have access to the original capital, it's just that income. So a trust which is coming around more and more often now. Lots of providers are starting to offer this sort of with their sort of draft trust deeds, is a flexible reversionary trust. So this is kind of being looked at as the best of both worlds, to be honest. So it's flexible, but it's also effective for IHT a lot quicker than a loan trust would be. So with this one, you gift your money into the trust with a series of scheduled payments back to you, or reversions, which you can choose to take in future years. You can also choose to defer them for further on into the future should you wish. Any growth is outside of the estate from outset, so ticking the box for IHT. And then after 7 years, the full gift can be outside of the estate too. So obviously an important distinction between this and a loan trust. With a loan trust, you can access the capital whenever you want. With a flexible reversionary trust, you can access the capital when certain segments fall due. So those segments can be, and they can be sort of outlined when they'll fall due at outset, so you have control over that. And you get to choose when those segments become available in future years. So it pairs the 7-year clock with genuine flexibility, which is useful if future income needs are uncertain. Okay, so if you cannot move it, another option is to insure it. So what's also available are whole of life policies. So this is an insurance policy which covers you for the whole of your life, as the name would suggest. Pays out a lump sum on death, which is then used to cover an inheritance tax bill. So the money pays out into trust, and we write it that way just so the sum assured as it pays out doesn't then form part of your estate, causing more inheritance tax. Obviously, it's something which you need to weigh up the costs of doing it. If you start doing this later in life, it will become more costly to insure it because death is closer. But it is another and quite popular option of mitigating an inheritance tax issue. So a common worry which has been coming up after this was announced in the budget recently is whether people should stop paying into their pensions. For most people should carry on paying into their pensions regardless of what's going on at the moment. So pensions are still the most effective way when saving for retirement. So you get tax relief at your highest marginal rate, and all growth, any dividends received, remain tax-free. That's the most powerful advantages of a pension, and that's why for most people we still suggest that they keep on paying in. This change affects what happens to whatever is left when you pass away. So if you were to divert money from a pension and start saving it into an ISA instead, you'll still end up paying inheritance tax on that. But obviously you wouldn't have benefited from the tax relief as you go through your working life. So for most people, continuing to save in a pension still makes sense. The planning now is more about what you do with the surplus, not about abandoning pensions completely. The real risk here is overcorrecting, stopping contributions or stripping out pensions too quickly, which could cost you a lot more than this change in tax regime could. Okay, so another hidden knock-on effect is the £2 million cliff edge. So some may have heard of this, others not. And what this is, it relates to what allowances you have for inheritance tax. I'll touch on them quickly. So we've got the nil rate band, which is 325,000. Everyone qualifies for that. Those who own their own home and pass it to direct descendants also qualify for something called the residence nil rate band. That's an additional 175,000. So for a single person, they have allowances of 500,000. Married couples have an allowance of £1 million. So the cliff edge I'm talking about here is once the total estate starts going over £2 million, by every £2 that you go over, the residence nil rate band reduces by £1 until it's extinguished completely. Obviously, with pensions now coming into the estate, more and more estates are going to be creeping over that £2 million threshold, especially if we're close to 2 million now, and then we've got another 20 years of expected income growth, all of those things, more and more people are going to go over that £2 million. So it's a strong reason to look at your whole estate with the pensions included, really just to work out where you stand. Okay, so putting all of it together then, the strongest plans rarely rely on one move. A blend of several of these is usually the best option. So an option you can obviously use is gifting out of regular income or starting that 7-year clock, bearing in mind that most gifts will remain inside of the estate for the full 7 years. Trusts also are an option. So if you don't want to make an outright gift, you still need to rely on some of that money. and you'd like some control over what it was used for potentially, that's where trusts become an important part. Also covering part of the liability or all of it. That's where insurance comes back in. And this may change the order in which you start to spend assets. So whereas pensions have been preserved in the past, now pensions may well be the first place that we start to take from and then look towards other assets to begin with. So I think in a nutshell, really, depending on your circumstances, is which tools that we pick out of the box to solve your problem. And yeah, speaking with an advisor is the best way to figure out the best plan. Okay, so part three, who needs to act first and what can wait? Okay, so who needs to act sooner? Larger unused pensions likely to face IHT. So if you've got a big pension building up, you need to start thinking about this now. Those who are older or in poor health, less time to gift. Life expectancy at the moment, we use the assumption from the ONS that people usually pass away in their early to mid 80s. When forecasting sustainability of income, we usually go further past that, just to give a margin of error, really. But I think mid 80s is the number we usually go with. Anyone whose pension was a plan for inheritance. So, as I alluded to earlier, the seasoned advice before these changes was preserve your pension, spend everything else first, because the pension will be free from inheritance tax. Obviously, the landscape's changed now, and as advisors, we need to change with that and pass on that advice to our clients. So, who have probably got a bit more room to wait? So, married couples, whilst still think about this, but there's no IHT on first death, so there's still some breathing room. And obviously, again, that depends on your personal circumstances. So we may be thinking of a couple where the wife is older, husband, yeah, I mean, any number of reasons could mean that death happens quite quickly one after another. So it's not a sit on your laurels sort of situation, but don't worry as much. Anyone still relying on their pension for income? So if you've got a drawdown pension, you're slowly whistling it away, but you might be above your IHT allowances at the moment. At a point in the future, you may be below it. And that's where some of those tools help that I mentioned, where we can model cash flows and the likes. And smaller estates already within nil rate bands. So this is a probably wait, because again, we need to think about, you might not have an issue now, but what happens when your assets grow over the rest of your lifetime? So probably wait. I think probably is the key word there. And as I've said earlier, the order you spend may need to flip. So you might start spending ISAs and other savings first, or sorry, you would have done, leaving pensions untouched. So it passes free of IHT. From April next year, that's no longer the case. So it may make sense to draw from pensions earlier, spending or gifting that surplus income. Okay, so the mistakes people make by waiting, leaving things and not dealing with them. So, like I've said earlier, a lot of these strategies to reduce or mitigate inheritance tax completely can take a lot of time. So the longer you wait, the less effective they'll be. Also, assuming nothing changes just because you're married. It's just the IHT problem comes at second death rather than first. Also, this might scare people into making large gifts now. A conversation with an advisor would be really sensible there, because can you afford to make that large gift now? Factoring in that the price of everything that you buy will go up. You may have certain plans that you haven't factored in, such as, I don't know, potentially a holiday, or whatever it may be, that could eat up some of your capital. Overlooking gifts from surplus income. So it's an easy, immediate win that a lot of people leave on the table. And also doing nothing at all, just in case the rules change again. Obviously, one thing we can be certain of in life, and that's change. That's why you have an advisor that can move with that change. Okay, so your runway, a bit of a timeline here. So what everyone should be doing now, really, or certainly at least at their next review point for existing clients, and we'll be doing this as a matter of course, is review your estate and pension and model your numbers and your situation. So applying those expected growth rates, where is the pension likely to sit in X number of years? Are you going to spend enough of it for your with income to get you below your nil rate bands? 2026, obviously this year again with gifts, you want to start making the 7 year clock running as soon as possible, and the same with placing money into trusts. Spring next year, final HMRC guidance lands. I'll probably do another webinar at that point, just so we know what's exactly going on. Excuse me. And the 6th of April, so not long after the spring, arguably still part of it, the new rules will take effect. Okay, so we're coming to the last couple of slides now. Just a final slide on how we can help. So we can model your likely IHT exposure under the new rules, work out what you can do now, what could potentially wait, and put the slowly moving parts of plans in place now while there's still time, getting the most out of them that we can. Obviously, if you'd like, you're not a client already, and you'd like to book a no obligation review, my contact details are there. And yeah, even if you've got a couple of questions, feel free to get in touch. As I've said, no Q&A today because I'm speaking to myself as we had audio issues. And just a final disclosure on today's presentation. I'll leave that on screen for a couple of seconds, but if you're watching this, thanks very much for lasting until this point, and look forward to seeing you at the next one. Thanks.